What if I told you the place you have always been told is safest for your money is, right now, one of the most dangerous? At Berkshire today, we are holding roughly $334 billion in cash and very short-term treasuries. That is the largest cash position this company has ever had. That is money I am not putting into stocks, not using to buy whole businesses, not rushing to deploy. For someone who has spent an entire lifetime putting every available dollar to work, that should get your attention. You are taught that when the world feels uncertain, you go to cash. You sit in what looks like a safe harbor in a quieter environment. That was a reasonable habit. But the world you and I are standing in now is different. Prices are rising faster than most safe instruments can compensate. What looks like a fortress is, in reality, a structure with the floor slowly sinking under it. Over the past 18 months, I have been taking apart positions that took decades to build. At one time, I called Apple the best business I had ever seen. I still think it is an extraordinary company. Yet we have sold more than half of our stake. We cut back sharply on Bank of America. We stepped away from institutions that had been core holdings for years. And I did that while the market was setting new records, not in the middle of a panic. For most of my career, I have been the fellow who buys when others are afraid and holds when others are tempted to jump in and out. During the financial crisis in 2008, I was writing checks. During the pandemic crash in 2020, I was still willing to commit capital. So when you see me selling into strength and then letting the proceeds pile up as cash, you should not assume it as business as usual. In our most recent reporting, Berkshire sold roughly $36 billion more in stocks than we bought. That is not tuning the engine a little. That is pulling the car off the track. The result is that enormous cash hoard you've been hearing about, it is now larger than the entire annual output of many developed countries, larger than the market value of most companies people talk about on television every day. I am not holding that by accident. People who have followed my writing for a long time might say, well, Warren is just waiting for his pitch. He will swing when the price is right. There is some truth in that. Price always matters. But there is another factor I am asking you to pay attention to. Inflation does not care whether you are patient or impatient. It quietly eats every dollar, whether it is sitting in your wallet, your bank account, or a money market fund. Right now, in many cases, the interest you can earn on safe instruments is very close to the rate at which your money is losing purchasing power. Sometimes it is less. You see a number going up in your account, and it feels like progress. In real life, that same number buys less food, less energy, less health care. That is what I mean when I warn that cash by itself has become a dangerous comfort. So why am I, of all people, willing to sit in that same cash? The answer is not that I think cash has suddenly become wonderful. I do not. The answer is that I look around at the prices being asked for businesses, for stocks, for real estate, and in many cases I do not like the odds you are offered if you buy at these levels and then hit a rough patch. There are times in markets when your choice is not between good and bad, it is between bad and worse. Equities in many sectors are priced as though very little can go wrong. Bonds, especially longer dated ones, offer returns that barely exceed or sometimes fail to exceed what inflation can take away. Real estate in a lot of places have been bid up to levels that leave little room for disappointment. In that sort of environment, a person with a very long runway and large operating businesses behind them might reasonably say, I will endure the slow leak for a while rather than risk blowing out the tire entirely. But I want you to be very clear on one point. I have advantages you do not. Berkshire has earnings from railroads, from utilities, from insurance, from dozens of strong operating companies. Those earnings arrive whether we put one more dollar into the stock market or not. We can afford to let a large cash balance dribble away in real terms for a period because we have fresh cash coming in all the time. Most people listening to this do not have that luxury. If you are retired, if you are hoping your savings will carry you through another 20 or 25 years, if you are counting on your portfolio to throw off income, inflation is not a theoretical chart for you. It is the reason your grocery bill is higher, your rent or property tax bill is heavier, and your health care costs are more painful. Imagine you are a typical investor or retiree. You save carefully, You moved into what everyone told you was the responsible position, cash and bonds. You believed that caution was rewarded. But now you watch as stocks make new highs, yet you feel no safer. Treasury yields are higher than they have been in over a decade, but when you subtract what inflation is doing to you, the real return feels microscopic or negative. You are caught in the bind I described. There is no comfortable choice. Some investors followed my actions and went heavily into cash. They are accepting the erosion because they believe the alternative, buying into this market at current prices, is riskier still. Others went the opposite way. They chased yield into corners of the market that worry me. High dividend stocks that may not survive a downturn. Junk bonds with attractive coupons but a real risk of default. Real estate trusts are already stretched on valuation. Both groups are making rational decisions driven by fear. That should tell you something about where we are. The old rule was simple. Cash and bonds were safe. Stocks and property were risky with potential reward. That relationship has turned upside down. Cash now guarantees a slow loss of purchasing power. Stocks and real estate at today's prices carry the risk of sudden, sharp losses if sentiment turns. You are being asked to choose between certain slow damage and possible fast damage. Neither is appealing. Let me walk you through how inflation actually works on your life, not on a government chart. If you look at history, you see the same pattern again and again. The stagflation of the 1970s, when inflation ran into double digits and people on fixed income saw their standard of living collapse. Workers demanded raises, but prices rose faster than wages. Savings accounts paid interest, but inflation ate through it like acid. Then the Latin American crises of the 1980s, where hyperinflation in Argentina and Brazil wiped out the middle class almost overnight. You could be prudent your whole life, and then one morning, your currency is worth half what it was the week before. The Asian contagion in 1997 did the same thing through currency collapse and capital flight. These are not ancient history. They are lessons in what happens when money loses the trust of the people who use it. Closer to home, think about the years after the 2008 crisis. Central banks printed money on a scale no one had seen before. Many warned that inflation would explode. It did not, at least not right away. But now, more than a decade later, that bill is coming due. All that money worked its way through the system. Supply chains were disrupted. Governments borrowed and spent without discipline. And now prices are rising in ways that people feel every single day. Let me give you a concrete number so you understand what I mean. Take $100,000 that someone held in cash at the start of 2020. Inflation has been running, on average, around 5% a year. By 2025, that $100,000 buys what roughly $78,000 would have bought 5 years earlier. More than a fifth of the purchasing power gone. Not lost in a stock market crash where you might recover, just gone steadily every year. And here is the part that matters most. It compounds. Every year, inflation eats a percentage of what is left. A retiree who needed $50,000 a year in 2020 now needs more than $64,000 to live the same way. 5 years from now, if this continues, they will need over $80,000. 10 years out, over $100,000. You cannot plan for retirement using the old numbers. The old numbers are fiction. You might be thinking, can the Federal Reserve not just raise rates high enough to stop this? That is what Paul Volcker did in the early 1980s. He pushed rates above 20%. It caused a brutal recession. Unemployment hit nearly 11%. Businesses failed. Families lost their homes. But inflation came down, and it stayed down for decades. So why not do that again? Because the world we live in now is fundamentally different. Start with the debt. The United States government owes more than $36 trillion. When Volcker raised rates, federal debt was less than $1 trillion and about 30% of GDP. Today, that ratio is past 120%. The interest expense on that debt is already over $1 trillion a year. If rates went to 10%, just the interest would eat up more than $3.5 trillion annually. That is more than the entire federal budget outside of Social Security and Medicare. Think about what that means. If the Fed tried to do what Volcker did, the government would have to cut deeply into programs people depend on, or raise taxes so sharply that the economy would seize up. Neither is politically possible. Congress can barely agree on routine spending bills. The idea that they could handle a tripling of interest costs without triggering a fiscal crisis is not realistic. Then there is corporate debt. American companies borrowed trillions at near zero rates over the past 15 years. That debt has to be refinanced. If rates jump to 8 or 10%, many of those companies would be in serious trouble. Layoffs would follow. Defaults would follow. The economy is not built to absorb that kind of shock anymore. On top of that, there are structural forces pushing prices higher, no matter what the Fed does. For 30 years, companies moved production to wherever labor was cheapest. That kept inflation low. Now, for reasons you can see in the news every day, that is reversing. Supply chains are being shortened. Manufacturing is moving back onshore or to friendlier countries, but at a higher cost. That is not temporary. That is a permanent change in how the economy works. Demographics are working against us too. The baby boom generation is retiring. The ratio of workers to retirees is falling. That puts pressure on wages, on Social Security, on Medicare, on health care costs in general. Energy systems are being rebuilt to move away from fossil fuels. That requires enormous investment, and someone has to pay for it. All of these things push prices up, regardless of what the central bank does with interest rates. So the Fed faces a choice with no good answer. Raise rates sharply and risk recession, mass unemployment, defaults, and a debt crisis. Or keep rates modest and let inflation grind away at everyone holding cash and bonds. The evidence tells me they have chosen the second path. Rates have risen from near zero to around 4%, but that is still far below what Volcker did. And already there are cracks showing. Regional banks failed in 2023. Commercial real estate is under stress. The Fed has been forced to slow down and even hint at pausing or reversing. The tools that worked in the past are not available in the same way now. You can see the results in how people are moving their money. In the first half of 2025, investors pulled more than $120 billion out of money market funds. That is not a normal portfolio adjustment. That is capital fleeing what used to be considered the safest spot. Money market funds were the default home for idle cash for decades. Now they are seeing outflows for the first time in years. Where is that money going? Into gold, which has pushed past $2,400 an ounce, and at times has gone over $2,500. Gold does not pay interest. It does not generate income. It just sits there. The fact that investors prefer it to cash tells you how much confidence has been lost. Central banks are buying gold at the fastest pace in decades. China, Russia, India, and Turkey, all adding to reserves. When central banks themselves are diversifying out of dollars and into hard assets, that is a signal you cannot ignore. Commodities in general are climbing. Copper, silver, and agricultural products. This is not driven by shortages. It is driven by people treating physical goods as stores of value because they do not trust paper. Real estate trusts are seeing inflows even though property prices are already high. The reasoning is simple. People need housing. Rents can be raised with inflation. Physical property feels more real than a bond. Even cryptocurrency, which I have never been enthusiastic about, is seeing inflows driven not by technology enthusiasm but by monetary fear. When people start treating a volatile digital token as safer than dollars in a bank, confidence in the traditional system has been damaged. The institutions are moving too. Pension funds, endowments, the most conservative investors in the world are cutting back on cash and plain bonds. They are moving into real assets, infrastructure, inflation-protected securities. The California pension system, one of the largest in the world, has talked publicly about reducing nominal bonds. Texas has increased real asset holdings. These are not speculators. They are fiduciaries managing trillions, and they are telling you through their actions that cash and bonds cannot do the job anymore. Corporate treasurers see the same thing. Companies with large cash piles are watching them erode. Some are buying equipment now rather than later because the real cost will only go up. Others are paying down debt or returning cash to shareholders. Anything to avoid sitting on depreciating currency. Apple, Microsoft, Alphabet, all rethinking how they manage cash. That shift tells you something. For decades, cash was the anchor. When you were unsure, you went to cash. That made sense in a world where inflation was low and stable. But that is not the world we are in. Cash has become a position of certain loss. Not volatile, not uncertain, but certain. And, every year it buys less. That is a fundamentally different risk than a stock going down and possibly coming back. You can also see the fear in market behavior. The VIX, the measure of stock market volatility, spikes not when companies report earnings, but when inflation data comes out or when the Fed makes an announcement. Traders are positioning for huge swings based on tiny changes in inflation numbers. 1/10 of a percentage point difference from expectations can move the market by hundreds of billions. Every Fed statement gets picked apart word by word. If the chairman uses the word transitory instead of persistent, billions move instantly. If he says the Fed is monitoring inflation rather than committed to bringing it down, the reaction is immediate. Markets have become hypersensitive because they do not know what the policy will be. You can price in steady inflation. You can price in aggressive rate hikes. What you cannot price in is randomness. This is different from past cycles. In the Volcker era, everyone knew the script. Rates would stay high until inflation broke. Investors could plan around that. Fiscal policy followed known paths. But when policy shifts month to month based on political wins and economic surprises, valuation becomes guesswork. How do you value a company cash flows 10 years out when you cannot estimate what a dollar will be worth? How do you price a bond when the return depends entirely on choices that seem to change constantly? Corporate earnings calls show the same confusion. Chief financial officers are saying openly that they cannot forecast costs more than 1 quarter ahead. Supply chain managers are hoarding inventory and locking in long-term contracts at high prices just to have certainty. That behavior itself pushes prices up, which makes the problem worse. This is what happens when unpredictability takes over. People stop planning and start hoarding. Efficiency drops, prices rise. Now, let me bring this to your daily reality. Grocery bills for the average household are up roughly $1,200 a year compared to 2020. Energy costs, whether gasoline or home heating, are significantly higher. If you rent, you have seen increases in many markets of 30% or more since 2020. If you own, your property taxes and insurance have climbed. Maintenance and repairs cost far more. Healthcare premiums, deductibles, and co-pays all rising faster than incomes. This is not statistics. This is money that used to go into savings but now goes to covering higher costs. A family that was saving $500 a month 5 years ago can barely do that now on the same income. The personal savings rate has collapsed. Credit card balances are rising. The financial cushion that people built during the pandemic is mostly gone. For retirees, it is worse. Imagine someone who retired in 2020 with savings they believe were adequate. They plan to withdraw 4% a year, a rule that worked for decades. But if inflation runs at 5% and the portfolio earns 6% nominally, the real return is only 1%. That is not enough. After 5 years, that portfolio in real terms has shrunk significantly. The income it throws off does not buy what it used to. Social Security provides cost of living adjustments, but those lag the real increases retirees face, especially in healthcare. Bond markets are reflecting the same loss of confidence. Foreign buyers, who for decades were eager purchasers of United States Treasury bonds, are pulling back. They are repricing the risk. If a bond yields 4% but inflation runs at 4 or 5%, there is no real return. If the dollar weakens against their currency, they lose even more. That makes so-called risk-free assets carry real risk. Pension funds are in a mathematical bind. They have fixed obligations. They promised retirees specific payments, but the cost of meeting those promises in real terms keeps rising. Many funds are already underfunded. Inflation makes the gap wider. State systems in Illinois, New Jersey, Kentucky have funding ratios below 50%. If they fail, it is not the wealthy who suffer. It is teachers, firefighters, police officers who spent careers paying into systems they believed would be there. This is not market volatility. This is systematic destruction of wealth happening quietly. documented in every sector. Now imagine a specific person, a 65-year-old retiree with $500,000 in savings, invested conservatively, mostly bonds and cash, as they were told to do, earning 4%, generating $20,000 a year. Add Social Security, and total income is perhaps $50,000 that felt adequate at retirement. But 5 years of 5% inflation means that $500,000 now has the buying power of $390,000. That $50,000 in income needs to be $64,000 just to keep up. Where does the extra money come from? It does not. This person simply becomes poorer every year. Social Security adjusts a little, but not enough. The portfolio cannot generate higher returns without taking more risk, and at 65, there is no time to recover from a major loss. Shifting into stocks at current valuations risks a crash. Buying real estate or commodities sacrifices liquidity. There are no good answers, only less bad ones. Now multiply that scenario across millions of households. Roughly 47 million households in the United States are headed by someone 55 or older. Tens of millions are facing some version of this problem. Their savings are not keeping pace. They are being forced into choices that lower their standard of living or expose them to risks they did not plan for. Multiply it across small business owners. A business with $200,000 in operating cash is losing $10,000 a year in purchasing power. That is money that cannot go to wages, to supplies, to growth. Small businesses employ nearly half of private sector workers. They are being quietly taxed by inflation. Many raise prices, which feeds the cycle. Others cut staff or close entirely. Multiply it across young families trying to save for a home. If they are saving $40,000 but home prices are rising at 6% while their savings earn 3%, they fall further behind every month. That locks them out of ownership or forces them into larger mortgages and more debt. It entrenches inequality between those who already own assets and those trying to build wealth. Each person, each business, faces the same impossible calculation. And when millions make defensive choices at the same time, it drags the whole economy down. Businesses delay investment. Hiring slows. Households cut discretionary spending. The cumulative effect is lower growth, which makes the underlying problems harder to solve. Lower growth means less tax revenue for governments already buried in debt. It means fewer jobs, especially for young people. It means less innovation because everyone becomes risk averse. The confidence that drives an economy forward gets replaced by fear and caution. And slower growth makes inflation harder to fix because you cannot grow your way out of it through increased production. So the question comes back to you. What do you do? I cannot give you personal advice. Your situation is different from everyone else, but I can tell you what I see. No one is coming to rescue you. The government will not make your portfolio whole. The Fed will not prioritize your retirement over broader goals. Your employer probably cannot give raises that match your real cost increases. You have a responsibility to yourself and your family to understand what is happening. Inflation is not a number on a screen. It is an active force reshaping your financial reality. That means educating yourself. It means questioning assumptions that worked for decades but may not work now. It means considering options you dismissed before. It might mean owning more pieces of real businesses that can raise prices over time. It might mean holding some assets tied to physical things in the world. It might mean rethinking how much you hold in plain cash and bonds. Every person's answer will be different depending on age, income, risk tolerance, and time horizon. But doing nothing because it feels safe or familiar is itself a choice, and it is a choice with consequences. Inaction guarantees a slow loss. Leaving money in a savings account earning 1% while inflation runs at 5% is choosing to lose 4% every year. A bond portfolio earning 4% nominal when inflation is 5% is choosing to go backward. These might still be your best options given the alternatives. But they need to be conscious decisions, not defaults you drift into. And understand this, unlike a stock market crash, where the damage is visible and sharp and might prompt action, inflation does its damage slowly. You see your account balance go up a little and think you are fine. You do not realize until years later that in real terms you have been losing ground the whole time. By then, much of the damage is irreversible. My warning is not about the $334 billion sitting at Berkshire. We will be fine. My concern is for the person who saved carefully, who trusted that being responsible would be enough, who believed cash and bonds were unshakable safety. The rules underneath those beliefs have changed. You do not need to panic. You do need to wake up. The ground is shifting under your feet. Inflation is not a forecast. It is here. It is eating purchasing power every day. The longer you pretend the old rules still apply, the more ground you lose. I have been investing for more than 70 years. I have seen a lot of cycles, a lot of crises, a lot of environments where it felt like there were no good choices. This is one of those times. But in every environment, the people who do best are the ones who see the situation clearly, accept it, and make deliberate choices instead of hoping the problem will go away. Cash is no longer the hero of your financial story. It might still play a role, but it cannot be the foundation it once was. The sooner you accept that, the better your chance of protecting what you have built and passing something real on to the people you care about. If you found this conversation useful, if it helped you see your situation more clearly, I encourage you to seek out more analysis like this. There are people doing serious work to help you understand the forces reshaping your financial life. Subscribe to sources that offer depth instead of noise. Share what you learn with family and friends who might be navigating the same uncertainty. Knowledge is one of the few things inflation cannot take from you. The ground has shifted, the rules have changed, and the sooner you understand that, the better positioned you will be to navigate what comes next.